I think many of you know more than 600,000 kids in almost every state in the country last year played the stock market game. Joining us today are two stock market game participants, Alexander Bandon and Melissa Maldonado, both of Kenwood K-8 Center in Miami, Florida. Their teacher, Maria Goldstein, is here in our audience as well. Please welcome Alexander and Melissa, who will give you their impressions of playing the stock market game. Who's going first? You are? Go to it. Are you?
Hello, my name is Alexander Bandon, and I'm here from Miami and Kenwood K-8 Center. We're currently participating in the stock market game with our teacher, Maria Goldstein. Our class of 18 was split into 6 groups of 3, and each group was given a team member, and the team member was the only person who was given the team password. That means that the team cannot function without the team captain. Every day during the class period, we spend about 20 minutes adjusting our stock portfolios and checking our gains and losses. We're using the stock market game currently as an extension of a lesson that we took last year in our computer class, which we used a spreadsheet in Microsoft Excel to keep track of stocks that we bought with a hypothetical $10,000. We used formulas that we had learned the semester before in Microsoft Excel to put in the stock values, but I found the stock market game to be completely superior to what we did last year. It gives us all the values that we need quicker and easier in an easy-to-use format. We buy our stocks based on the Fortune 500 list, which has served us well in some cases, but not so well in others. Some of our stocks, like Electronic Arts and Intel, have made my group a lot of money, but some of the other stocks that we bought off the Fortune 500, which I don't think I should say, they didn't do that great, which led to a loss of a lot of money in the group. So we found out the hard way that basing your purchases in one place isn't always the best way to go. So as of recently, we started using the PE ratio and tried working as much on inside transactions, sorry. My teacher's having a conniption over there. Well, we're trying to get as much information on insider transactions as we can because we know that if the CEOs of the companies are investing in their own companies, then there's probably a good chance that they're about to make a lot of money. So another thing that we check is the financial section of the paper every day to see possible acquisitions or mergers, or if a company's services will be expanded. The majority of my team's time in the stock market game is spent investing, researching, buying, and selling, but we also spend a lot of time in the market mysteries section. So far, my team has completed the first 3 beginning level stock market mysteries. At first, the clues were somewhat confusing, but the second time through, they really started to click, which made the notebook section a big help. It was the key to solving the mysteries. At first, navigating was kind of tricky, but after we figured it out, we had no problem going through it. And I would like to thank Mr. Schaefer and Morgan Stanley for funding the market mysteries section. All in all, I found the stock market game to be an incredibly well-designed learning tool. I would like to congratulate all those involved in its creation, and I hope to continue the good work. Thank you for your time.
Good morning. My name is Melissa Maldonado. I am an 8th grade student at Kenwood K-8 Center. In our class, we are competing against one another in the stock market game, so I won't reveal all our strategies. Before we buy a stock, we check its price and growth for the past days, months, or years. We also see if the company might come out with a new product that we think is going to be successful. We do the same thing like people who actually invest in stocks, except we don't have a stockbroker and that it's not real money. Every day, the team manager logs the team in and we check our rankings first. Then we see our account summary and account holdings. In the account summary, we check if we have a good balance or if we are in debt. In the account holdings, we check our stocks, if they're doing well or we might need to buy or sell more of them. And this depends on the unrealized gains or losses of the stock. My group used to be in a $5,000 debt because we accidentally bought Syntex on margin. We had 50 shares of Syntex, then we bought 250 more for the price of 97. We didn't realize our balance couldn't hold up the cost of the stock until class was over. We got out of debt by selling several of our stocks. We sold eBay, Home Depot, and some Hot Topic. We learned a lot more about what it means to buy on margin. My group bought several stocks in some companies that we believe will do well for the long run, and some we thought would be good for dump stocks, quick dump stocks. To our team, quick dump stocks are ones that we thought would be good for a short time, such as Adobe, Dillard's, or General Electric. Based on our research, we thought that Nokia, Sony, Syntex, and Rockwell were stocks doing well enough to keep. Even though we had to sell some of our Hot Topic to get out of debt, we felt that this stock would do well enough to hold. Since we are a team of 4, we have to vote on what stocks to buy or sell. Majority rules in our case. There's usually one person who disagrees with the other 3 people, so we try to convince them on how good it would do for the team. If they still don't agree, we just do what we propose and see how it turns out in the end. The stock market game is a fun experience when you're ranked high, but when you're not doing well, it's not as much fun. However, in the long run, it teaches us valuable things. We are learning how to think and make financial decisions, how to manage our money, and how much we should set aside for spending. We also learned that investing in the market is one of the things that we can do with our money instead of putting it all in a savings account that doesn't give much interest. We also learned that decisions made by the government and others like the Fed affect the market. For example, the other day we learned that the Fed was going to keep the short-term interest rate at 1%. Then we saw that the market went up the next day because people felt confident and bought more stocks. Thank you for giving me and my classmates the opportunity to participate in the stock market game. It was fun learning.
Great job. Very good job. Thank you. We'll go that way. Thanks. Well, Alexander, I'll let you know that when you got into that insider trading thing, Chairman Donaldson hadn't come into the room, so I think you're and Melissa, you're right. When you're not doing well, it's just not as much fun. I think that we'd all agree with you on that. I would now like to introduce Karen Tyler, who's the North Dakota Securities Commission. Karen also serves as the chair of the Investor Education Section Committee for the North American Security Administrators Association. Karen?
Thank you, John, and congratulations to you on a very successful year. And I'd also like to thank Alex and Melissa for sharing their experience with us and for giving us some good advice as well. Good morning to all of you. I am Karen Tyler, the North Dakota Securities Commissioner and also the current Investor Education Chair for the North American Securities Administrators Association. And it is truly a privilege and a pleasure to be here with you today. And I would like to thank Laura Goldzung for inviting me to take part in your annual meeting and share a little time with you this morning. We have about a foot of snow back in Bismarck, North Dakota, so an invitation to Boca was very well received. Before I get into my remarks, if you would indulge me, I would just like to take a moment. Could I get a show of hands as to how many of you have seen the movie Fargo? Okay, I can't pass up this opportunity to set the record straight. That movie was actually based on a story that took place in and was filmed in the state of Minnesota. So I'd appreciate it if you would spread the word. Okay, back to the matter at hand here. It is a great pleasure to be with you this morning and share some thoughts on an issue that both industry members and regulators wholeheartedly agree upon. And you may be wondering, what in the world could that possibly be? And that is the importance of improving youth financial literacy and the need for industry and regulators to continue to support financial education and to continue to deliver financial education to the youth in our communities and our jurisdictions. First and foremost, financial education makes a positive difference in people's daily lives. First and foremost, financial education helps our young people to lead better lives as adults, having learned how to save, invest, and use credit wisely. Additionally, financial education has far-reaching implications for the financial services industry and its regulators. In reviewing the agenda for your annual meeting, it is clear that many of your discussions and presentations focus on factors that will influence your business in the future. Factors such as legislation, upcoming elections, economic conditions, capital formation, and very importantly, investor trust and confidence. I would like to add one more factor to that impact list, and that is youth financial literacy. How will the level of financial literacy of our young people today influence your business tomorrow? Melissa and Alex are not only here today as successful and enthusiastic participants in the stock market game, they are also here as representatives of the future. Melissa and Alex represent the driving force behind the future health of our economy. They represent the driving force behind the future profitability of your companies. Alex and Melissa represent your future client base. They represent your future employees, your financial advisors, your planning specialists, your CEOs. And in the future, as Alex and Melissa hit full stride in their working lives, they and their generation, with their investing and spending behavior, will heavily influence the economic conditions into which many of us will retire. There is a direct correlation between their financial decision-making aptitude and the future success of your companies that should be factored into any long-term strategic planning process. Now, I should probably just speak for myself here, but I think it is fair to say that state securities regulators may not be as good as you all are at long-term strategic planning. For some of us, it's hard to plan past the next election, as we might not have a job, or it's hard to plan past the next legislative session, as we might not end up with a budget. But state securities regulators have an ongoing obligation to ensure that our constituents, no matter what their age, are equipped with the knowledge that they need to make good financial decisions and to recognize and avoid financial fraud. The ability to make good financial decisions can make the difference between our young citizens becoming productive economic contributors or becoming dependent on government-provided services. The ability to make good financial decisions ultimately impacts the economic health of our families, our communities, our states, and this country overall. Clearly, our greatest allies in this endeavor to deliver financial education to our youth are the men and women in the trenches, our teachers in the classroom. And while we seek them out as partners in this process, We must be mindful of the pressures that they face in the classroom and continue to work with them to provide resources such as the stock market game that can be easily integrated across a standards-based curriculum. Every summer, our agency holds a teacher training event called Invest North Dakota. We bring in approximately 100 teachers, both elementary and secondary, and over the course of the week-long event, we provide them with training, tools, and resources that they can take back to the classroom and utilize in their efforts to teach personal finance concepts. The topics we cover with our teachers include such things as how to teach economic concepts as early as kindergarten through 6th grade, how to safely utilize internet applications in the classroom, training on a variety of finance curriculums designed for junior high and high school students. We dedicate one day of the event to presentations by securities industry professionals who volunteer their time to discuss such topics as the basics of investing, asset allocation, and investment alternatives. And this segment is always a favorite with our teachers and is very valuable to them both personally and professionally. We bring in a representative from the Teachers Fund for Retirement to discuss fund performance and answer any questions that they may have. And we provide training on the stock market game with a representative from SIFI joining us to discuss integrating this resource into a variety of curriculums. The North Dakota Securities Department has been coordinating and providing funding for the stock market game in North Dakota since 1996. We have had approximately 24,000 students participate in the game. It has been used in 143 schools. And I am pleased to report that this fall the game is setting new records in North Dakota for the number of teams and students taking part. We currently have 940 teams and 3,000 students participating in the game. My remarks this morning simply serve as a reminder that both industry members and regulators must remain vigilant in the quest to improve youth financial literacy. There is much at stake, and we must remain committed to supporting financial education, and we must remain committed to delivering financial education to our young people. The Securities Industry Association and the Securities Industry Foundation for Economic Education have much to be proud of in this endeavor, and I commend you on all of your efforts. My congratulations and thanks again to Alex and Melissa, and I would also like to extend my gratitude to their teacher, Maria Goldstein, for her dedication to bringing financial education into her classroom. Thank you all for your time and attention this morning, and I wish you a very successful conference.
Thank you. Great job. Thank you, Karen. We value your contribution to investor education and your support of the stock market game. I encourage all of you and your firms to get involved. Please stop by the SIA table in the exhibit hall for more information about the stock market game. I now would like to present a Distinguished Leadership Award to Richard Bruckner. Rich has been an important participant in the stock market game for 11 years and has served as its chairman since 1995. Rich will be honored on December 1st along with the New York City Mayor Michael Bloomberg at the SIA New York District Economic Education Annual Benefit Dinner. Rich, please join me on stage to accept your award.
Say 2 words, sir?
Sure,
Yeah.
always.
Thanks, John. Thanks also to the board for their support over the years through what's been a little bit of a difficult environment and a significant transition for the stock market game program. Also, thanks to the staff that's put up with me for these 7 or 8 years, whatever it's been, and for Alex and Melissa and Karen for making the great case for the stock market game program. Most of all, thanks to all of you who have participated in the game by adopting schools and by your financial support for the stock market game program. It is a wonderful thing, and it's about helping people. It's about the future, and so I appreciate this award very much. I'm honored, and thanks for your help.
Can I say 2 words, sir?
I now have the honor to welcome Chairman William Donaldson. Bill is the 27th Chairman of the Securities and Exchange Commission. Since he became chairman, he's moved swiftly and effectively on many fronts to rebuild the investing public's trust. He's taken swift action against wrongdoing. He's proposed significant changes in the regulation of hedge funds and mutual funds. And he's made market structure issues a high priority to ensure that our markets are the most efficient and most competitive globally. And he's worked closely with the states to coordinate investigations while strengthening the preeminent role that the SEC plays in developing and enforcing regulations that protect investor interests. Please join me in welcoming SEC Chairman William Donaldson.
Congratulations to Rick Buckner for the stock market game and all that you have achieved. It's very inspirational, to say the least. Ladies and gentlemen, good morning, and thank you for having me here today. I must begin by reminding you traditionally that the views I express are my own and do not necessarily represent the views of the Commission or its staff. And let me warn you that my message today is an unpleasant but important one. It's a message that I hope each of you will seriously consider. The SIA, as the primary trade group for the nation's broker-dealers, is in a unique position to be an active participant in the solution to the ills facing the securities industry today. I use the word ills deliberately. Since joining the SEC, and even before then, I've been distressed, as I'm sure many of you have been, by the conduct we have seen from key participants in our nation's securities markets. The most recent examples of this conduct are, of course, the late trading and market timing abuses that have been dominating the headlines. These offenses now must be added to a laundry list of industry wrongdoing, which includes the analyst conflicts, the IPO abuses, the failures to give investors the breakpoint discounts to which they're entitled, sales practice abuses, and the hidden incentives some brokers have when favoring one mutual fund over another. I'm left with the conclusion that these occurrences represent a fundamental betrayal of our nation's investors and are symptomatic of a disease that has afflicted far too many in the industry. And while I don't want to indict the whole industry for these recent problems, we all have got to work together to combat them and to work toward finding the proper remedies for the industry's woes. Our nation's investors are a loyal and resilient group. The Dow is up. Money continues to flow into our nation's mutual funds. We at the SEC are doing everything in our power to protect those investors and ensure that their trust is not misplaced. In a moment, I will outline for you our plan, but we obviously can't do it alone. Indeed, you need to consider what you as an industry can do to regain the trust and loyalty of America's investors. I have a few ideas on that subject too. Just as a surgeon operates to excise a patient's disease, we too must operate to excise the wrongdoers in our securities industry. Toward that end, the SEC's enforcement staff is vigorously ferreting out and punishing wrongdoers wherever they appear in our markets, including in the brokerage industry. Prior to recent damning revelations, the SEC staff has been focused on a number of areas. One of our focus areas has been mutual fund sales practices and fee disclosures. In particular, our staff has been looking at precisely what prospective mutual fund investors are being told about revenue sharing agreements and other incentives doled out by mutual fund management companies and mutual funds themselves to brokerage firms who agree to feature their funds. We are concerned that there may be inadequate disclosure of the source and nature of these payments, and the fact that such payments may increase costs to investors as well as create conflicts of interest between investors and the financial professionals upon whom they rely. A second area of focus is the sale of different classes of shares in the same mutual fund. Very frequently, as you know, A fund will have issued 2 or more classes of shares, A and B shares and so forth. Each class will have a different fee structure associated with it. In the last 6 months, the Commission has authorized enforcement actions against 2 brokerage firms in connection with the alleged recommendations that customers purchase one class of shares when the firm should have been recommending another. Yet another area of focus is the abuse of so-called breakpoints. Regrettably, our staff and the staff of the NASD has found numerous instances in which it appears brokerage firms failed to give investors the discounts to which they were entitled. This week, we've issued, together with the NASD, Wells notices to a significant number of brokerage firms for their failure in this regard. Such scandals erupted early in September. Here's what we've done on the enforcement front to attack late trading and market timing abuses. We sued a registered rep for having allegedly facilitated late trading by some of his clients. We charged a senior executive of a prominent hedge fund with late trading and barred him from association with an investment advisor. We also barred and imposed a $400,000 civil penalty on a mutual fund executive in connection with his alleged role in allowing certain investors to market time his company's funds. We instituted an action against a major investment management firm and 2 of its portfolio managers who allegedly market time their own mutual funds, the funds they were running themselves. And just this week, we charged 5 brokers and a branch manager with having misrepresented or concealed their own and their clients' identities in order to facilitate thousands of market timing transactions. In each of these matters, we've coordinated closely with state regulators who have also filed their own charges. If there is more wrongdoing, we will find it and we'll punish the perpetrators. On September 4th, the Commission staff sent detailed compulsory information requests to the largest mutual fund complex and brokerage firms in the country, including all of the country's registered prime brokers. Based on the responses to these requests, Commission staff have been dispatched to conduct on-site investigations and interviews and further investigation at dozens of firms. The findings to date are damning. More than 25% of responding brokerage firms reported that customers have received 4 p.m. prices for orders placed or confirmed after 4 p.m., thereby enabling late trading. In a matter of market timing, almost 70% of the responding brokerage firms reported being aware of timing activities by their customers. Further, documents provided by almost 30% of the responding brokerage firms indicate that they may have assisted market timers in some way, such as by breaking up large orders or setting up special accounts to conceal their own or their clients' identities, a practice sometimes called cloning, to avoid detection by mutual funds that sought to prevent abusive market timing. This last statistic raises the issue of omnibus accounts, the purchase and redemption of mutual fund shares through an omnibus account held at a brokerage firm often makes it for funds to fully protect their shareholders. In the breakpoint context, funds can't track information about the underlying shareholder that might entitle the shareholder to breakpoint discounts. In the market timing context, funds are inhibited in their ability to assess redemption fees, limit exchanges, or even kick out a shareholder who's market timing through an omnibus account because they don't know the identity of that shareholder. I believe now is the time for the brokerage industry to consider this problem and how it may be addressed. And I believe now is the time for the Commission to do exactly the same thing. Of course, it's not just the brokerage industry that's to blame. Mutual funds themselves have also been complicit. Through the same requests for information, we learned that emails submitted by approximately 10% of the responding mutual funds contained references to situations that involved late trading. 3 fund groups reported, or the information provided indicated, that their staffs had approved a late trading arrangement with investors. With respect to market timing, 50% of the responding fund groups appear to have had at least one arrangement allowing for market timing by an investor group. In order to prevent these types of abuses from occurring in the future, and in order to prevent other innovative types of fraud, we, all of us, must be bold, decisive, and aggressive in our plan of attack. Let me outline for you the minimum steps we need to take and have begun. We must ensure that effective mechanisms are in place for compliance with applicable laws and regulations, including the appointment of a chief compliance officer. We need to promulgate clear rules to prohibit abusive and wrongful activity, including rules to address late trading. We must ensure aggressive enforcement of violations of the securities laws, including the disgorgement of ill-gotten gains. We will implement and further develop effective commission surveillance tools to monitor industry compliance. We will call for industry adoption of ethical standards focusing on placing the interests of investors first. We must mandate effective governance structures for mutual fund boards. We must address conflicts of broker-dealers in marketing mutual funds. We must take prompt and meaningful action to address investment advisor conflicts in the management of mutual funds. We must improve disclosure to investors, including costs and other fees charged to investors when investing in mutual funds. And we need to ensure greater oversight over unregulated entities that can adversely affect mutual fund investors. We are well on our way to implementing many of these items. For example, we will be moving forward to make mutual fund fees and expenses more transparent and enhance disclosure of incentives and conflicts that brokers have in offering mutual fund shares to investors. In a few weeks, the Commission will consider a package of proposals to be brought before the Commission to combat late trading, market timing, and these other abuses. The staff is preparing rule proposals that will require a fund or certain designated agents, rather than an intermediary such as a broker-dealer, to receive orders and fund transactions by 4 p.m. for an investor to receive that day's price. This hard cutoff would effectively eliminate the potential for late trading through broker-dealers who sell fund shares. The staff will also recommend that the Commission adopt the Mutual Fund Compliance Policies Rule, which the Commission proposed last February. This proposal calls for a Chief Compliance Officer accountable to fund directors whose responsibility it would be to ensure that funds have effective policies and procedures in place to prevent activities such as late trading, market timing, and the selective disclosure of portfolio holdings. The staff will recommend explicit disclosure in fund offering documents of market timing policies and procedure, as well as their policies on disclosing information regarding portfolio holdings. These disclosures would enable investors to assess a fund's practices in these areas and determine if they are in line with their expectation. This regulatory reform package is just the beginning and represents our immediate response to the abuses we've seen so far. I've also asked the staff to consider whether funds should have additional tools available to thwart market timing activity. If the profit potential can be taken away from market timers, we can eliminate abuses in this area. For example, the staff is considering a recommendation that the Commission proposes rules to require mutual funds susceptible to market timing activity to impose a 2% fee on subscriptions by short-term traders. I will not hesitate to call for other measures if we discover additional information in the course of our investigation that merits regulatory action. That being said, however, I've got to emphasize that the nature of the problems that we have uncovered in our investigations dictate that we not only address the specific problems identified, but that we also ask whether there are structural, governance, and oversight issues that must be addressed in the mutual fund area. The Commission must be open to considering additional measures that would improve oversight of the fund industry and assist in preventing the types of lapses that we're currently investigating. No reform, whether structural, fund governance, or board composition, is off the table. Also on the table is a review of how we at the SEC go about our business. We are reevaluating how we use our resources, how we conduct our exams, how we can better harness the technological resources now at our disposal with the additional funding we are receiving from Congress. Additionally, I'm assembling a risk management group within the Commission that is tasked with looking forward at what could be tomorrow's abuses, not just abuses in the mutual fund industry, but all aspects of the securities industry to anticipate and hopefully head off major problems before they occur. Moreover, we've ordered a reassessment of our policies and procedures on how tips are handled. Tips from whistleblowers are critical to our mission of pursuing violations of the federal securities laws. I want to be sure that there is appropriate follow-through in this type of information and that they are given expedited treatment. The SEC's Enforcement Division's track record has been impressive. Over the past year, we've placed new cops on the beat, stepped up enforcement of securities laws in all areas. In the 2003 fiscal year, which ended September 30th, we filed a record of 679 actions, up from 484 2 years ago, a 40% increase with almost no increase in resources. We've also worked to return funds to investors who've suffered losses, rather than merely collect those funds for the U.S. government. Part of these efforts, we've attained the single largest civil monetary penalty ever imposed for violations of America's securities laws, and the proceeds from this penalty will be made available to harmed investors. We are also pursuing a broad agenda to make America's security markets more secure. For example, we've been examining the hedge fund industry, and the Commission staff recently released a comprehensive report on hedge funds, suggesting that hedge fund advisors be required to register with the SEC. Some have argued that hedge funds are in no need of regulation, but in the course of the late trading and market timing investigation, we are seeing how the activities of certain hedge funds can adversely impact ordinary investors. We are also continuing to encourage and monitor improvements in corporate governance at the nation's self-regulatory organization, especially the New York Stock Exchange. Under the interim leadership of John Reed, the exchange has made important progress in designing a reform board and governance structure. Both the exchange and the Commission are far from done, however. There has been important progress, though. Now let me turn to how you can help in bolstering investor confidence and making our markets more secure. The matters that we are investigating highlight conduct that violates the very principles of trust and fairness that represents the very foundation, the fundamental building block of our equity markets. These episodes provide valuable ammunition to critics who charge, wrongly in my opinion, that the little guy can't win by investing in our markets. That is what makes this continuing stream of fiduciary failures so very damaging. The headlines sap investor trust and confidence and potentially drive people to pursue alternative investments. So far, fund investors are staying loyal to the investment vehicle and have not redeemed their shares. But the industry now bears a higher burden to earn the trust of investors. Restoring public confidence has been and is no small challenge. Indeed, it will be a major, long-term undertaking that will require companies throughout the securities industry to move beyond just basic compliance and to establish new standards of integrity. Investors, whether in the United States or abroad, must be able to see for themselves that your industry and other industries have moved beyond simple compliance with the new laws and are living up to the spirit underpinning all of our security laws. Indeed, the future success of the industry, the security industry, and our capital markets hinges on the industry's ability to police itself with standards that go beyond perfunctory legal compliance. This is not a new idea. In Joseph Kennedy's first major speech as SEC chairman back in 1934, he pointed out, and I quote, that wealth in the form of corporate securities can be maintained and developed only by a continuing free and open market, where the investors may buy and sell their securities assured of the going price and protected from sharp practices. For the securities industry and for all of American business, it should be clear that we are in a new era with higher standards and enhanced scrutiny by regulators, business partners, and the public at large. There are and will be new bright-line rules to be observed, but these rules alone will not prevent the onset of corporate corruption. Indeed, I hope that the securities industry and the entire business community, for that matter, will see these lines as the bare minimum when it comes to compliance. Because if there's going to be a true restoration of long-term confidence in the U.S. economy and the global economy, what's really needed is the full engagement of the securities industry in an effort to advance an underlying spirit of reform. Every firm needs to conduct a fundamental assessment of its obligations to its customers. These assessments must be done at the lowest and the highest levels. Senior management and the board should be ready to issue directives, codes of ethics about precisely what it means to put the customer first. They must identify, eliminate, manage, and/or disclose the conflicts of interest between their firms and their customers, and they must do it in a forthright manner. Moreover, there must be a commitment to giving these ideas teeth, meaning that those who stand in violation should face swift and severe punishment. In short, it's critical that there be an industry-wide mindset to do the right thing, and that this becomes part of the industry's DNA from top to bottom. While the industry has had a long road of reform, ahead of it, there are signs of progress. Significant resources are being committed to implement the global settlement, as well as recently approved SRO rules that seek to promote the independence of analysts and the integrity of the sell-side research and the independence of corporate boards in general. And some firms appear committed to exceed rather than merely meet these new standards. I've also been pleased to see that the Bond Market Association is developing best practices, guidelines to manage research analyst conflicts in the fixed income markets, even though these markets have not been the focus of recent reform efforts. The securities industry should play a critical role in helping to improve the corporate governance of American companies at large. First, you can lead by example. As symbols of America's economic dynamism and vitality, you can be role models for good corporate behavior. Second, as you conduct the transactions that are your everyday business, you can be a force for reform, insisting on high standards among your business partners and acting to root out unethical behavior where you find it. By helping to raise the ethical bar, you can help to create an environment where the interests of shareholders and customers are second to none. I spent many years in and around the securities industry, during which time I've seen that we've had the world's most creative and most industrious workforce. I've also seen that this industry is populated by fundamentally decent and honest people. Indeed, these traits provide the foundation of the economic vibrancy of the United States. The securities industry has found itself stuck in a legal and ethical quagmire. But I'm confident that the industry will work together to pull itself out of the muck and to live up to a higher ethical standard. You can be sure that if you don't, those of us in government will. In closing, I want to thank the SIA again for giving me this opportunity to speak at your annual meeting. I'm sorry that the message is as it is, but those are the facts, and these are the directions that we're going in, and we're going to need the help of everybody in this room. Thank you very much.
Just the kick in the can we need and deserve. Thank you, Chairman Donaldson. I want to assure you that you will have the support of the SIA and the support of the entire industry in doing exactly what you've asked us to do, which is to undertake fundamental reform. They say the best way to be introduced is by someone who works for you, and I hope they're right. I've worked for Phil Purcell for almost 15 years, going back to when Deanwood was owned by Sears, and we were a 19,000 person organization with about 7,000 brokers and 150 investment bankers operating in the US only. Since then, Phil has presided over Deanwood's public offering and our spinoff from Sears, our merger with Morgan Stanley, and he's grew the combined organization to now employ over 52,000 people in 26 countries around the world. Somewhere in there, he created the Discover Card, raised 7 sons, became a trustee of his and my alma mater, Notre Dame, and founded the Financial Services Forum. It's my pleasure to introduce my friend and my boss, Phil Purcell.
Good morning. I think, like all of you, I have 2 words to say to Chairman Donaldson on his remarks, and that is that I agree. And I think we all agree and have the message. It was delivered directly and articulately, and we've got a lot to do. As my title of my remarks, Reconnecting with America, implies, we do have a lot of work to do. Some of our practices, some of our actions, referred to as ills by Chairman Donaldson, need to be changed now, and all of us have to do it in each of our companies and the industry as a whole. So my remarks this morning will be no different than anyone else's. I will be discussing what our industry can do to rebuild investor confidence and our capital markets. But before getting to the subject of how we can restore trust, I'd like to step back a bit and consider the question of why. Why is it so important that we rebuild trust? Obviously, investor trust is important to our industry. We couldn't stay in business without it. It's also important as an end in itself. People should be trustworthy. Beyond that, trust is also the cornerstone of our capital markets, which bring together the providers and users of capital. The capital markets have driven economic growth since Alexander Hamilton had the federal government assume the debts of the states, which freed funds for new investment in the new country. Since then, of course, U.S. capital markets have grown in size and sophistication, and now our markets attract more capital than the rest of the world combined. Today, our capital markets are more important than ever. Even with last quarter's robust growth, we are going to need more business investment to sustain the current recovery. And as our economy goes, so goes the world. Our country also faces the urgent need for infrastructure investment in transportation, the power grid, water, and education. Without strong, effective capital markets, we will not be able to raise the more than $1 trillion we will need over the next 5 years. The current U.S. account deficit has recently jumped to an annual rate of more than $500 billion, or more than 4% of GDP. As we import more goods and services, we continue to export certain jobs, and the current trend is to exporting knowledge jobs as well. And we're not going to create new jobs without effective capital markets to channel the investment into growth sectors and new enterprises. So when we talk about restoring confidence, let's not forget that there is far more at stake than simply the health of our industry. We're talking about our country's economic future. The rebuilding of trust will not be easy. We must move beyond rhetoric to disciplined, concrete steps that enhance the way we conduct our business. The standards we must meet in the future are higher and different from the past. We can and must improve ourselves to meet them. We say that investor trust is ultimately the responsibility of our industry, and it is. But others have also taken strong actions to help restore trust. Congress passed the Sarbanes-Oxley legislation designed to strengthen corporate governance and reassure investors. Our regulators, the SEC, the NASDR, and the New York Stock Exchange, as well as the New York State Attorney General, have investigated many of our practices and have put into place new rules that should give investors more confidence. All of these actions have helped, and the markets have begun to respond positively. But investor confidence is still well below where it should be, and we need to do more. As you've heard this week in discussions of the latest SIA investor survey, there is still a long ways to go in rebuilding confidence, and it's not going to be easy. There's no map. It's almost like the tourist seeking directions from an old New Englander who is told you can't get there from here. But of course we can. And in fact, we must. We're not going to get there, however, simply with repeated declarations that our industry must take the lead in improving our business practices or by reminding employees that they must adhere to certain basic values. Exhortation is necessary, but alone is not going to get us there. Is anyone going to say that they don't believe in integrity? We must move beyond good intentions to disciplined, concrete steps. We can begin by directly and actively addressing the conflicts of interest that exist in our business, the sorts of conflicts that have helped bring the decline in trust. In a speech this September before a securities group, Steve Cutler discussed what he called a conflicts crisis on Wall Street. Cutler is right. This is not a crisis that will soon pass or to which there is a quick, easy solution. In our business, we are surrounded by conflicts. Not just conflicts between our own interests and those of our clients, but between different parts of our firms and between the clients in one part of the firm and those clients in another. There's even a client in simply acting as an intermediary between a buyer and a seller. The better the price for one, the worse it is for the other. We come to work every day and face conflicts. The crisis is not that conflicts exist, but in not fully acknowledging them, disclosing them, and forthrightly addressing them. This is not an issue we can solve by assuming that conflicts are easily managed according to business as usual. The conflicts are not always readily apparent, so the first step in disclosure is disclosure to ourselves. Steve Cutler's challenge to our industry is to find the problems and correct them now. And I would add, for all of us, and keep finding them and keep correcting them. We've gotten the message. Here's some of the things we're trying at our firm. And I know all of you are trying things at your firm, as it is a learning experience, and we need to get better. The first thing we've done to respond to Cutler's charge is we are undertaking a top-to-bottom review of conflicts throughout our firm to identify potential problems. To make sure that it's thorough and that we get beyond business as usual, we have asked Eric Donalo, who just joined us from Elliot Spitzer's office, to lead this conflicts examination effort with the support of every business leader in our firm. This will not be a one-time effort. Given the dynamic, changing nature of our business, we want to make sure that conflicts examination becomes a continuing practice. Adding Eric Donalo to our senior management is a DNA transfer to all of us, a transfer that should make us more sensitive to potential conflicts. In the near future, we intend to have additional similar DNA transfers at the highest levels in our management and governance. These DNA transfers need to be in the front end of the transaction and disclosure process. This is much more rewarding than investing in cleaning up matters that we have missed. Second, we're going to look at every product to initiate additional disclosure where we think it might make our investors better informed or more comfortable. We are not going to wait for instructions or help from the regulators. We will take the initiative ourselves. Third, we intend to approach the regulatory examination process with a more positive, proactive mindset. Examiners have the benefit of seeing best practices at all the firms. They can make comparisons and determine which practices are in fact the best. We'd like to think of examiners as doctors who can improve our health. We can be a stronger company by listening to the doctors in a positive way as they consult on best practices, not just check for rule infractions. This should be a collaborative, not an adversarial effort. In all of our efforts to rebuild trust, we have to recognize that the world we're in today is not a temporary aberration. It will not go away. Our world today was brought on by a combination of events, the bursting of the internet bubble and some corporate scandals, and as John Schaefer said yesterday, more than a couple of self-inflicted wounds. It is the result of the way we have sometimes dealt with clients. How can we improve our practices? All of us say we believe we put the client's interest first and that client satisfaction is a top priority, or that we would have no business without our clients, which is certainly true. So it's easy to talk about focusing more on clients, but far more challenging to accomplish. Too often our industry has tended to view our business mainly in terms of transactions or the product and services we offer, with clients simply the buyers of these goods and services. It's difficult to put yourself in the position of your customer and view what you do from their perspective. Creating a truly client-focused organization requires the questioning of successful time-honored practices and real cultural change, which is never easy. I certainly don't have all the answers, but I'd like to share with you some of the things we have been thinking about to bring greater client focus to our business. And I should stress that what we are doing is very much a work in progress. We are learning. And I'd like to share these ideas in the spirit of this conference and the best spirit of the SIA. It's by sharing ideas on what each of us is doing that we can eventually arrive at best practices and all get better. What we've tried to do is to make client focus less of a mantra and more of a strategy, a business strategy in the full sense of the term. We have always been systematic in measuring the profitability of different products and businesses on an ongoing basis. Now, we are trying to be equally systematic in measuring client satisfaction. And this means rethinking everything we do and every way we interact with clients. For example, client focus means looking at every fee and justifying it from the way the client would perceive it. This goes beyond disclosure. Fees need to be described in a way that the client knows what they are for. Does the client understand that he or she is in fact receiving something of value for the fee? Client focus means a careful review of all of our communications with clients. We spend millions of dollars a year mailing information to clients. Much of it is promotional or sales-oriented. We are asking whether each of these pieces is indeed useful to the client, or whether we are just getting our name in front of them. The latter is simply clutter from the client's perspective. So we're re-examining just what clients need and seeing if we can tailor as much of our communication as possible to each individual client. Client focus means getting out on the front lines with financial advisors who interact with the individual investors. Client trust can rise or fall on the relationship between the client and the financial advisor. In fact, we all know confidence would be much lower today than it is if it were not for the trust that most investors continue to have in their own advisor. So we're trying to do more with that relationship, making sure our advisors are asking the right questions, like how they could do a better job and how we could do a better job. We should not have to wait for the latest SIA survey to learn what our customers are thinking. As a result of getting out there on the front lines with our financial advisors, we have learned a great deal about how our clients view us, and we are using this information to guide every aspect of our business going forward, such as training, compensation, and retention. When we focus intently on client satisfaction, it becomes clear very quickly who is likely to succeed in this business and who is not. These are just some of the things my firm is doing to establish the disciplined focus on clients that can help rebuild investor confidence. I know that similar efforts are underway at other firms throughout the industry, and we must make sure it continues. No matter what we do, however, we are not going to be able to fully rebuild investor trust on our own. We need validation, not in the pop psychology or daytime TV sense, but validation from a credible outsider who says to the rest of the world, yes, they are as good as their word. We need partners, and our partners in rebuilding confidence are very strong and balanced regulators. John Schaefer said here a year ago that we must accept the need for regulatory reform. But this change in regulatory reform, as Chairman Donaldson said, is a continuing effort, and we have to move on it together. The industry and regulators working together to make sure we protect investors and foster strong, efficient markets. The fact of the matter is that free markets cannot operate without effective regulation. Free market capitalism could not exist without basic rules regarding property and the enforcement of contracts. Our industry depends on strong regulation to help build and maintain trust. A trust, as I mentioned at the outset, that is vital to strong capital markets and economic growth. There is a lot at stake, and it goes beyond the U.S. economy. There is a huge stake when you consider how much the global economy and hopes for improved well-being of people throughout the world depend on capital formation and growth. Could China enjoy an 8% GDP growth while simultaneously going to a market economy without the global capital markets, many of which are anchored here in the U.S.? I doubt it very much. As we look to the future, our industry is in a position to make a vital contribution. We have been in a harsh spotlight. But as a result of this spotlight, the industry has moved towards making needed changes. It began with the investment banking research settlement led by the SEC and the New York Attorney General's office. At the urging of the SEC, the industry has begun a hopefully thorough review of conflicts of interest. As a result of vigorous regulatory investigation and enforcement, it's clear that we are also going to see significant reform practices in the mutual fund industry. The process of reform is going to continue, and we must continue to play an active part. We must embrace change. As we've seen in the new governance proposals for the New York Stock Exchange, change is likely to go beyond particular regulations to the regulatory structure itself. We must all be open-minded and actively engaged in these proposals. As I've said, a great deal is at stake. We owe it to ourselves, not just as members of this industry, but in our role as citizens of this country and participants in the world economy. Thank you very much. See you, Chief. Yes.
We are now going to take a 15-minute break, so try to be back at 10:45. Thank you. Thank you for doing that. Not your highest. Welcome back. I'd like to thank the Wall Street Journal for hosting our morning break. Please join me in thanking them. I'm now very pleased to introduce John Reed, Interim Chairman and Chief Executive Officer of the New York Stock Exchange. As many of you know, John retired as Chairman and Co-Chief Executive Officer of Citigroup in 2000 after a distinguished 35-year career at Citi. In his short time at the helm of the exchange, John has done an outstanding job providing a steady hand during this period of transition. His expertise and leadership skills were immediately in evidence. He's demonstrated a firm commitment to ensuring that the exchange meets the highest standards of excellence in fulfilling its role as a marketplace and as a regulator. Ladies and gentlemen, please welcome John Reed.
Thank you very much, and let me say I'm very happy to be with you. When you said that the Wall Street Journal had hosted the event, I wondered if I was here to talk to them, but I was happy to hear it was just the break. So, in any event, what I'd like to do this morning is tell you a little bit about what I sense as sort of a retired person who was happily sitting on a beach and got called back into action. And I thought what I'd do would be to share my sense of what I think is going on in a broad sense, and then I'm going to tell you a little bit, not too excruciating detail, what we're doing in the New York Stock Exchange. I do have a message. The message is really very simple. We are going to see a profound change in terms of boards of directors, what they do, the degree to which they intrude on what we used to think to be the management of our businesses, and the degree to which we will see that they are engaged. And I think that this is something that will be new and different. I frankly think it'll probably be good for corporate America, and it'll be good for the industry. And I think that we'll find that we're lucky that, given the problems that we've had, that the response of the American public is to say, hey, let's make boards take responsibility and do their job, as opposed to other reactions which might have included intervention and regulation and so forth and so on. So as I see it, we've gone through a period that's been difficult. There have been a lot of things that have happened that should not have. And the reaction of the American people appears to be, let's make boards assume some responsibility, take a more positive role in terms of the activity of corporate America, and let's hold them accountable for what they do. From my point of view, the story starts back in the 80s. In the early 80s, the general feeling was that corporate America was asleep. We'd lost our competitiveness, the Japanese particularly, but international competitors in general were doing pretty well, and many American companies were not. It didn't take long for some investors to find out that they could take a position in the company's stock. They could put pressure on the board to reform their ways, throw out the CEO if necessary, put in a new management, and focus on improving corporate performance, get rid of the divisions that weren't paying off, get the assets deployed in places that could pay off, and improve performance. This turned out to be a lucrative business for investors because obviously you bought in at a low price, you turned the company around, the company became more valuable, and you were very happy. The notion of shareholder value came into being. When I first was elected chairman of Citi in '84, I'd never heard the phrase shareholder value. Today, you cannot pick up an annual report, you cannot talk to a CEO without finding shareholder value as the driving force shaping decisions that are being made and directions that are being taken. Obviously, along with shareholder value, if you're a cynic, you could argue that we created also the super CEO, also the super compensated CEO. Companies started giving stock options and getting what was thought to be alignment between shareholder value and compensation programs. And there was a general feeling that if you could increase the market value of your company by billions, what the heck difference did it make if various CEOs made hundreds of millions or 50 million or what have you? And so there was this general feeling that as long as shareholder value was being enhanced, compensation was secondary, and where you might have expected management to have a somewhat more balanced perspective, shareholder value counts, but there are other things that count as well. And that balance was lost because we did get alignment. We got total alignment. And the trouble is, obviously, as markets changed, we started getting misbehavior. People started trying to meet the expectations of the markets by managing earnings, and in some cases we got to out-and-out accounting fraud, but we certainly saw a lot of very unpleasant behavior, financial manipulation in which the financial community was involved, in extremes of income recognition, capacity swaps in the telecommunications area, vendor finance that made little sense, and so forth and so on. But not surprisingly, we took something that was probably a valid concept and we took it to extremes, and we have gone through in the last 3 or 4 years a series of revelations that have not been pretty. And frankly, none of us in this room can feel good about these things. And in the financial arena, the arena that we're all working in, we participated in many ways, and I don't need to detail to you all of the problems. When you get to the interface between the financial community and the consumer, it's always been messy. Pricing for the consumer, when I was in the banking business, pricing for, using teller machines, credit card fees, the foreign exchange charge on credit cards, the refinancing fees associated with mortgage refinancings, all of these interfaces with the consumer have been fraught with problems. They've been fraught with difficulty in terms of transparency of pricing. By and large, banks were thought not to be upfront and fair in terms of revealing to consumers all of the charges associated with their relationships, et cetera, and it doesn't surprise me at all that we're finding in the mutual fund area that there appear to be some abuses, and I would guess if you would look at the insurance area, you would find that there's a similar set of problems when the industry meets with the consumer, because the pricing has tended to be opaque and not necessarily clean and clear for everybody involved. So there are behavioral problems associated with the financial business that are unique to us. Some of them are on the table, but it's an arena where we have some responsibilities and some accountabilities. I think what's going on is the country has said stop. We are not held in high regard. Those of us in the finance business are not necessarily thought to have our customer interest at heart, and we have lost a tremendous reputation, and unfortunately it hurts the country and it hurts the economy, because if people don't have confidence in the financial sector, the economy is hurt by that, markets are hurt by that, and it isn't good for anybody. We've been told to clean up our act. We have a number of regulators on hand to help us do it. But basically what we've been told is, hey, clean up your own shop. And fortunately, what people have said is, let's get boards that are independent, let's get boards that are accountable, let's get boards that are transparent, and let's hold them responsible for ensuring that there is good corporate governance and that there is good behavior. People want outsiders on the board, not buddies of the CEO or people who are enmeshed in the industry. That means people who are outside of the normal community of interested groups. They want people who will be independent on boards, who will stand up and take a position that reflects their judgment, not necessarily the consensus of judgments that may exist within the firm. They insist on transparency. They would like boards to be open to suggestion, and under certain circumstances, the SEC is working on whether the boards should not be open to proposals for membership from outside of the normal selection process that most boards go through, and that's being discussed at the SEC now. Boards are expected to take line responsibility to check accounting, and in fact, the management of companies are being asked to sign off on accounting statements. Boards are being asked to certify that controls are in place, that executive behavior and executive compensation is well managed and visible to all, i.e. when you write the report of the Compensation Committee of the Board, you're supposed to tell people how it is that you reached the judgments with regard to compensation that you reached. Decisions are supposed to be properly taken. There's an interesting legal decision in one of the cases involving Disney where the board was held responsible for what they did not do as well as what they had done. But clearly boards are being asked to take responsibility that decisions are properly taken, and finally and most importantly that the business behavior of the firm is correct. And this list is going to go on. People obviously don't like to see it. Those of us who've run boards for years say, my God, why do we have to put up with all this? What's this corporate governance stuff anyway? And we're wrong, because the fact of the matter is we're lucky that society has decided let's make the boards work. There are alternative ways of trying to deal with these sets of issues, and they would be far less useful for the private sector, and they would be far less pleasant for the people engaged in corporate management. So my own sense is I've signed on. I think the notion of having a board that is full of outsiders, that is independent, that does have a certain transparency to its activities is a proper response. And I do think that boards have a substantive responsibility to know what the heck is going on and to make sure that it passes the test of reasonableness. Obviously, boards should not run companies and will not run companies, but they are going to be more intrusive and they are going to be more visible to stockholders and more accountable to the general public with regard to what goes on. As everybody in the room knows, I was called in to come into the New York Stock Exchange after what was described to me, and I think probably correctly, as a board failure. For whatever reason, the board of the stock exchange, in compensating the chairman and CEO, came up with a number that was generally felt by most to be extraordinary. And then when it came to deciding whether they could publicly justify this number, the CEO himself lost credibility. Eventually, the board felt that he had to go. And then when people asked the board, gee, how did all this happen? They said, well, we're not sure. And the combination of those three things obviously did not help the New York Stock Exchange. It did not help the industry at all. It did not help the reputation of Wall Street. And it has created a great problem. I was happily retired, and I do recommend retirement. It really is a lot of fun. And I got a call to ask if I could come and step in on an interim basis and see if I could take some first steps towards restoring credibility. My job, very simply, was find out what happened, because it's very difficult to correct something if you don't understand what it is you're correcting. 2, come up with a proposal that would remedy the problem. 3, recommend new management, permanent management. And 4, re-retire. Get out, go home. And that is exactly what I am trying to do. I asked, when people first asked me to take this job, do you expect me to get engaged in the discussion with regard to the structure and architecture of markets as to the particular form of market that exists within the New York Stock Exchange, et cetera, et cetera? The answer was no. What you are here for, John, is let's get a governance structure in place, let's get a management in place that can deal with those issues and that is equipped to deal with those issues. So my criterion was, let's see if we could get a governance structure in place that is not vulnerable to the mistakes of the past. Number 2, let's make sure that we get a structure in place that will permit the exchange to deal with the various criticisms that are out with regard to our performance and to our particular functioning, and deal with it in a constructive way. The exchange has a public purpose that is extremely important. It is the deepest pool of capital in the world, and any number of listed companies depend upon us to be able to raise capital at that exchange. Many investors depend upon us to be able to transact business, as do broker-dealers, and so we have an audience that depends on us importantly. The good news is that we continue to function every day and function very well. We have some problems in the Admiral's Quarter, but the ship is doing fine. The Admiral's Quarter is in need of some corrective action. What I did is, after talking to an awful lot of people, I came up with a proposal. And that proposal is now out for a vote. Immediately following my talk here, I'm going to go have lunch with about 80 or 90 members of the New York Stock Exchange who live in Florida and whose votes I need. And I am going to be talking to them why I would appreciate them Tuesday, a week from this next Tuesday, giving me support for this proposal. We are revolutionizing, from the point of view of the stock exchange, the way in which it is governed. What we are doing is we're beginning to look much more like corporate America, but for the stock exchange, it is a revolution because, first of all, there has been no tradition of any form of disclosure with regard to what happens in the stock exchange. When Mr. Grasso's pay was disclosed, it was the first time in history that there was disclosure of that sort, and so by surrounding everything we're proposing with requirements for disclosure, that to the stock exchange is a revolutionary step and not one that they're necessarily happy about. And secondly, we are asking the members to vote for a totally outside, totally independent board. And when I say outside, I mean people who do not come from the normal community of the stock market. That is a shock because historically the stock market has been governed by people who come from that community. They are not by any means outsider. So that's a tradition in most markets, but it will not be what we propose for the New York Stock Exchange. And these people are independent. And that doesn't make the members feel all that good either, because the notion of having a set of independent directors representing them is unnerving. They say, well, gee, these guys don't really know how to run the stock market. And I say, but the various board members in Boeing probably don't know how to design aircraft either. And yet you can, in fact, sit on the board of Boeing and presumably represent the stockholders of Boeing quite well. It may not be a big leap of faith in corporate America, but for the members of the New York Stock Exchange, having to elect a board that must, by Constitution, consist of outsiders who are independent is a major step. And so what we've proposed is that we create an outside independent board. The Constitution says it should be between 6 and 12 people. We put together a slate of 8 people that we are putting up for election. They all are, in fact, outsiders. They all are, in fact, independent. And they will perform all of the functions that you would expect a board to perform. They have ultimate responsibility to the New York Stock Exchange. One of the criticisms that I've run into from some is they would like the board to be representative of other interests. They would like investor interest represented and, listed company interest represented and so forth and so on. I have said no, I want an outside independent board. I think that's what the American people expect, and frankly, I think that's the best thing for the stock exchange, and I want a board whose interest is the New York Stock Exchange, not a subgroup that has its own agenda. We have a slate of people whose responsibility it is to do what is right for the New York Stock Exchange, and it is a capable board. I was careful to recommend for nomination on that board 4 people who had been CEOs. The reason I did that is some of our failures with regard to Mr. Grasso's compensation and so forth were due to the fact that the board was simply not run properly. And what most people would have expected in terms of normal board function simply did not occur. And by putting people on our proposed board who have been CEOs, who have run public companies, these people understand how a board must function, and if we don't operate properly, they'll put their hand up and say, sorry guys, this isn't how boards function, and we got to change our ways. Just to make sure of this, we have put in the proxy material that on an annual basis the board must self-assess. It doesn't self-assess with regard to the members, i.e. are these great people. We had great people on our prior board. The board didn't function well. It proves something that everybody in this room knows, which is you can have great people on a board, but if it's poorly organized, the agendas are badly set, and if the committees roll every 3 years, as our old ones did, you could have a malfunctioning board even with a lot of good board members on it. So I am not as interested in assessing the individual competence of board members. You get to do that when you vote for them, if you happen to own a seat in the exchange. But what I want the board to do is each year say, hey, is that which we have decided we must do the correct set of things? And I have a list of responsibilities in the proxy that I expect the board to meet. But each year the board will reaffirm or change what they believe their primary responsibilities are. Then they will say, do we have the information that is timely, accurate, and so forth that would allow us to deal with these issues? And finally, they have to say, is the board organized in such a way with committees, agendas, board meeting times, discussion, and so forth that would permit us to properly deal with these various items. And each year, each member of the board is being asked to certify that they feel the board's doing the right thing, they have the right information, the board's organized properly, and the time's appropriate to get the job done. All of this is designed to make sure that some of the problems of the past cannot reoccur. So you have an outside independent board, you have an outside independent board that has a clear set of accountabilities and responsibilities and has a self-correcting mechanism built in. It is also obviously important for the exchange that we maintain contact with what basically are our customers. Listed companies, the big broker-dealer organizations, in fact all broker-dealer organizations, the members from the floor, and the investor groups. So I have created what I call a board of executives, which brings these people together and brings them together about the things that are important for the industry. Does the exchange function properly and well? How is the regulatory process? Is it good and sufficient and so forth and so on? And what are the problems with it? How can it be improved and so forth? And then the more pressing question, what about the evolution of market structure in the United States? Where are we going, and how does the New York Stock Exchange move to play its part so as to better serve the community of investors and the community of broker-dealers and so forth and so on? And so I've created a body that could deal with these pressing issues, but that body has no fiduciary responsibility and no ultimate responsibility. They recommend things to the board of directors. They have committees that are drawn from both the board of directors and the board of executives, because if you're going to discuss market performance, you might as well have some people from the board on that committee as well, just so that they could be closer to the discussions. And if you're going to talk about market structure, we have a subcommittee to do that. We'll have a couple of the people from the board on that, but primarily you want the industry group input and so forth. People criticize us about the regulatory function. I have said nothing about whether self-regulation is good or bad. Self-regulation is what we today have, and what I have done is I have created a governance structure that I think most people, if they would look at it, would say is an appropriate governance structure to sit on top of a regulatory function. First of all, I have a totally outside independent board. In some alternate situations, you have a governance structure that has a lot of people from the industry sitting on the overarching board. We have a clean board. We have a committee of that board which sits on top of the regulatory function and has responsibility to appoint the head of regulation, to compensate the senior management of regulation, to assess the performance of regulation, and to basically assume responsibility for the regulatory function within the exchange, so that we have a regulatory function in the exchange that reports up to an outside independent board that is responsible for assessing the performance of that. And by the way, they could go to outside experts if they feel that to assess the performance of the regulatory function, it would help them to have a visiting committee of regulators or something to do that. The board is perfectly capable and competent to do that. Some of the best institutions in America are kept good because they have peer review. The major universities, the major hospitals all stay on top of things by having peer review. It would be quite possible to set up a peer review mechanism on regulatory function that could help the industry and help all of us stay on our toes. So we have put together a proposal that we're taking to our members to revolutionize, from their point of view, the structure of the New York Stock Exchange at the top. I have 2 weeks for them to vote. The Constitution requires that they be given 2 weeks to vote, so we've set the vote for Tuesday, the 18th of November. I am hopeful that we will have a substantial majority of the members approving this. There are about 1,400 members, 900 of whom are retired and tend to lease their seats, and hence they are down here in Florida. I had a meeting in Washington, D.C. this week. I'm meeting with people in Florida. I'm going to Philadelphia on Monday. I'm going to Cleveland and Chicago on Wednesday. I'm going to California, to L.A. on Friday, and to San Francisco on Saturday to meet with various member groups, because 900 of the 1,400 voters are not sitting around New York, and I need to explain what we're doing and make them feel comfortable that this is not going to dissipate the value of their seat ownership, and that this is, in fact, the right thing for the New York Stock Exchange to do. I am convinced that it is the right thing to do. It gets the stock exchange in a situation where it has a good board that could function and function well. It aligns the board with the interests of the American public. It creates a board of executives that allows the industry to be tightly coupled with the important decisions that the exchange will have to make going forward. What I consider its evolutionary pathway, I don't think it's a single decision. I think it's a set of decisions which will cause the exchange to look very different probably 7 years from now than it is today. But we have a mechanism in place to deal with that. And the next thing I have to do is I have to bring to this new board a recommendation for somebody to take my place. Now, that somebody may well be sitting in this room, and if you are, I'd like you to identify yourself so we could get on with this. But it is obviously very important for the exchange to have permanent management in place. There are a lot of things that I have opinions about that could be done in the exchange, and I've tried to restrain myself because it is simply not okay for an interim chairman to start, making fundamental management decisions or people decisions or other things, given that I'm likely to be there for 2.5 to 3 months. And that simply wouldn't be fair. But what I am trying to do is tee up this issue so that when we do have permanent management, that management will be able to hit the road running. Last night I sent a letter to my new directors, assuming they get elected, bringing them up to the curve, the various issues that they're going to have to be dealing with, and briefings on the problem we have with the specialists and all of the investigations that are going on, and some cost issues that we have, and all of the nitty-gritty that the board's going to have to begin to get engaged in. I also have a sheet of all the criticisms that have been levied at the stock exchange, because the board might as well get their mind around what different people think about the exchange. And so I have a nice long list. The Wall Street Journal keeps it current for me every day as to what's wrong with the exchange. I would be hopeful that in December we will announce that we have a person or persons to run the exchange. I want to do it quickly because, frankly, it's important for the exchange to have permanent management there, and I'd love to have them go into next calendar year with a management team and a board in place, because I think it will serve you and the industry well. I know it'll serve us and the New York Stock Exchange well, and frankly, I think it'll serve the American public well. And so that's what we're up to. But my little story, I repeat my introduction, is just this is one example of corporate governance changes that are needed, that respond to a problem that should never have happened. And we'll get these changes in place, and hopefully the place will be better managed because of it. But this is just one of many such changes taking place across the corporate landscape. I think you're going to find in the years ahead that boards are going to be different. They're going to have a more constructive role. They're going to be held to a much higher standard of accountability and responsibility. And I would urge all of you who have your careers in front of you, because I'm just on the way to my second retirement, but for the rest of you, I would urge you to understand that stockholder value encompasses behavior. If your behaviors get out of line, you're going to destroy a lot of stockholder value. And we've seen it in the marketplace. We've seen it in some bankruptcies and firms now coming out of bankruptcy. But people who think that stockholder value is contained in a simple number called earnings per share fail to grasp the reality of the business situation. And the American public's not going to put up with it. The American public is not going to say, hey, as long as the price of your stock goes up, we don't care what you do. Quite to the contrary, the American public cares a lot about how we conduct ourselves in our business, and we know the difference between running a business properly and not running it properly. Oliver Wendell Holmes said once that a dog can tell the difference between being tripped over and being kicked. And we can tell the difference between running a firm properly and dealing with customers properly and not. And it seems to me that it's up to us to make sure that we run our firms properly and that we respond to what I think are legitimate desires from the public, and the New York Stock Exchange is no exception. We clearly were not running ourselves properly. We did not have a governance structure in place that was appropriately responsive. We're trying to remedy that. I think we've taken a good first step. I think that it certainly tees up all of the issues that everybody in this room wants us to deal with, and it makes quite likely that we'll deal with them in an intelligent and constructive way, not encumbered by a lot of self-interest and other things which used to populate the board of the place. So I feel that we've taken a first step. I feel very proud that I was asked to come in and work on this, not because I'm enjoying it, I'm not, but because I think it's the right thing to do, and if we can do it and make a difference, then it will have turned out to be worthwhile. Thank you very much. I'm told that you have a tradition of questions and answers, so I'm in your hands. I presume the press is not included in that. If the press is, please warn me that you're from the press when you ask the question. I have different answers.
Will there be an independent chairman from the chief executive officer of the exchange?
Will there be an independent?
Chairman of the board from the chief
Yeah,
executive
well, I
officer.
mean, I don't know how you're independent once you get elected to be chairman, because, you know, the day you are elected as chairman, you become de facto part of the organization and you give up your independence. You become an insider. You're basically a corporate insider. But, you know, the tradition in the stock exchange, different than any corporate situation that I've seen before, is that the chairman doesn't run for election as a director and then get chosen by the other directors to be chairman. You notice, or you probably haven't looked at, but if you were to look at the proxy, my name isn't in it. Now, in corporate America, when I was at Citi, I ran for the board each year, and then the board would elect me, and I served. The tradition in the stock exchange, which we've maintained, is that the board's elected and then they elect a chairman. And the way we've written it is that they could choose one or two people. In other words, it's not hardwired in the Constitution. You could have a single person filling the role of chairman and CEO, in which case they must appoint a lead director from amongst the outside independent directors, or they could choose to have a non-executive chairman and a CEO. Presumably, they would select certainly the chairman if you had a separate one from outside. But it's not required. In other words, Mr. Grasso, I think, was the first chairman of the New York Stock Exchange who, in fact, had spent his whole career there and then was elected as chairman by the board. I think more traditionally, the chairman had come from outside and had been elected. But as soon as you become chairman, you are no longer independent. And that's why if you have a chairman and CEO, you do need a lead director, so when the board meets in executive session and so forth, it could do so without the presence of somebody who's an insider. I don't know what we'll do. My best guess, but it's just a guess, is we'll have two separate people. I think that reflects more the kind of people we'll be able to attract than necessarily the architecture of the job. If we could get the right person who was capable of doing both, obviously we would be quite happy to have a single person in that job.
After he retires, will Mr. Reed become a director?
What I have said, which frankly I had to say, was that if the new chairman wanted me to, and it seemed appropriate, I would be willing to join the board. From a personal point of view, I don't want to join the board. I want to go back to reading books, and I'm doing a little writing, and I've been doing a little teaching, and I'm engaged in K through 12 education stuff, which frankly I'm quite interested in. And I'd like to go back to that, and I've been dropping off all my corporate boards. When I retired, I'd been on 4 corporate boards, and I had dropped off all of them except Altria, which I have now dropped because I came to the exchange. And I was trying to spend my time primarily with foundations. But the trouble is, when you get on the phone and you call your friends and you say, hey, Dennis, will you join this board? We really need you. He says, John, are you going to be there? And it's awfully hard on the phone to say, you will, but I won't. It's just hard. And so what I've had to say, because it's the only honest thing to do, is look, if it's appropriate for me to stay on so as to provide some continuity and so forth, I'm willing to do so. I don't think being on the board is going to be horribly burdensome from a time point of view. And I am therefore, and I said this in the Congress when I was testifying, I was asked that, and so I am not willing to stay on in any executive capacity or any managerial capacity, if appropriate, which it may well not be, and if asked by the new chairman, and that may also not happen, then I would have to be willing to stay on for a while, just out of, it's solidarity. But my druthers would be not to be on the board.
Thank you, Mr. Reed, for your excellent presentation this morning. Is there a short list of candidates that you have at this point for your successor? You kind of noted you'd like to have someone replace you by Christmas, and there's not really a lot of time left to do that. And so that's my first question. And then secondly, among the key executives just underneath the CEO, are those people going to be selected by the new CEO, or is that something that the new governing board will have some say in as well?
Well, with regard to the candidates, as you know, I took this job on a Monday by chance. This was back in September, I think it was. By chance, there was a board meeting the Thursday following my first Monday at work, and there wasn't another scheduled board meeting till the first Thursday in December, and so I activated their old search committee, the one that had found me, and said, hey, why don't you guys start working on pulling together a list. They hired Spencer Stewart, and so we now have these beautiful blue books that you've all seen, and with lists of potential people. I know 2 or 3 people on that list who I would consider to be quite credible candidates. Doesn't mean they'd be available, but they certainly would be credible candidates. I intend to send that material from Spencer Stewart to the new board as soon as they are elected, and the old committee dies because the old board dies. I have the resignation of the old directors in my hand, which I can exercise at the time that I have a new board. I don't dare exercise the resignation of the old board till I have an elected new board, or we'll have no board. And but I did ask for and receive the letters of resignation for all the old board. So as soon as the new board has been elected, then I will turn them into that search committee. And I've been very careful to make sure that we got a list of 10 or 12 names so that, we're not presenting the new board with one person or 2 people. And so we'll get the new board's input, and they presumably will authorize me to approach some people, which I will do. And as I say, if I'm lucky, I'll get somebody. I could get somebody to say yes, but who wouldn't be available for a while. Fine, I'd stay as interim until the person could be available, but it would be nice to at least have them elected. And we may be lucky and find somebody who says, hey, January 1st, I'll be behind the desk, and that would be nice. With regard to the corporate officers other than the chairman and CEO, the board, as in most companies, has to elect these officers. We have to have an organizational meeting of the board, which would elect, the corporate secretary and the general counsel and the various, people of the senior management. I think there's 8 or 9 people that they consider to be their senior team. And they do have to be elected by the board. Normally, the CEO makes those decisions. And certainly, I have made no changes to that senior management team simply because I don't believe it's my job when I'm there for a short period of time to do that. I think the new CEO will have to decide whether that team is the right team for him or her, and number 2, is it appropriately configured? You could even argue that there's some reason to configure the team differently, but normally it would be the CEO who would recommend, and it would be the board of directors that would elect the people to any office or position that requires board approval. With regard, by the way, and I made this point before, but I better make it again, with regard to the regulatory function, that is decided by the Regulatory Oversight Committee of the board, and the head of regulation or supervision or whatever it's called reports to the chairman of the Oversight Committee of the board, not to the CEO. Just in Citibank, our chief auditor reported to the chairman of the audit committee, and the budget for the audit function was approved at the audit committee, and the staffing was approved, and the performance ratings and the compensation decisions for audit was all approved at the audit committee of the board, and we're going to basically do the same with regard to the regulatory function in the New York Stock Exchange, so that it'll report to an outside independent board. Yes?
The specialist system is one of the most controversial structures of the New York Stock Exchange. Before you elect a board or a management team, don't you think that one of the first things that has to be decided is whether the specialist system is going to survive, or what combination of a specialist and electronic? Because it will be conditioned, their function will be conditioned to what the basic structure of the exchange will be.
Clearly, the question about the specialist system is an important question. the decision about how we evolve from where we are, or if we evolve from where we are, that's a very, very important set of decisions for the sort of evolutionary pathway of the exchange. The people who should get engaged with and make that decision is a duly elected outside independent board. They are the best people to get engaged with that decision. The new CEO will undoubtedly have a point of view or will develop a point of view. But for me to make that decision as somebody who was elected by no one, is responsible to no one, and arrives from an island in France, spends 2 months in New York, makes a fundamental decision about the functioning of the New York Stock Exchange, the biggest capital market in the world, gets back on a plane, flies to Paris, and say, gee, I wonder what's going to happen, would be irresponsible beyond belief. So obviously, you got to get a legitimately elected, approved governance structure in place. You have to have a legitimately elected management in place to deal with that issue. It can't be dealt with before. It would be improper that it be dealt with before. I have opinions. Somebody may someday ask me for my opinions, and I've learned a hell of a lot in the last 3 or 4 weeks. But for me to make that decision before dealing with a governance issue, very frankly, makes no sense at all. Yes?
I don't know if this is working. Yeah, it is. Turning back to corporate governance for a second, could you just speculate for us on whether you think the New York Stock Exchange's current form, 1,366 owners, private, ought to remain, or would the transparency and the restoration of public trust and confidence be better if, however it happened, the exchange were a publicly owned corporation?
I think that is clearly a variable in the discussion. In other words, I believe that the ownership, clearly when the board's elected, they owe their loyalty to the owners. That's the capitalistic system. But I think our prime responsibility is to maintain the centrality, if you will, of the exchange and the role that it plays in capital formation in this country. And so I sense that we are going to have to get onto an evolutionary pathway that makes sure that the various people who depend on the appropriate functioning of the exchange feel that, you know, it can meet their needs and expectations and so forth and so on. I believe that the members of the exchange and I share a common view that as we try to define this pathway, it may be quite appropriate to look at altering the membership structure. The membership structure is highly fractionated. As I said to you before, 900 of the 1,400 members are retired, but they keep their ownership and they keep their vote. 30 years ago, that was not possible. 30 years ago, when you retired, you could not keep your ownership. That's a relatively new thing. Secondly, the members themselves differ. There are seats that are owned by the likes of Merrill Lynch or Goldman Sachs. There are seats that are owned by individuals. There are specialists and there are brokers on the floor. And so you have this hodgepodge, and it clearly could become a difficulty in terms of following the evolutionary pathway. In which case, and I think the members believe this as well, we may buy them in. I mean, the market cap of the stock exchange is about $2 billion. You know, there are about 1,400 seats that sell for $1.3 million each. We have almost $1 billion in cash on our balance sheet. You could imagine buying the membership in. You could imagine converting membership into stock ownership and going public. You could imagine buying a class of members in if they turned out to be disadvantaged by, you know, where you were going. Be it as it may, and this is one of the reasons I selected the board I did. I mean, these guys are competent to deal with these kind of issues, and this board is going to have to deal with those type of issues, and they are variables, and in my mind, they should be subordinated to the fundamental responsibility of maintaining the centrality of the exchange. And the members agree with that because if the centrality of the exchange disappears and we end up with fractionated capital markets, they're not going to have anything of value anyway. And so this process can and should be managed. My guess is it will be managed. But what I tried to do was to create a board that was capable of dealing with these kind of issues in a way that was open, transparent, and where the average American wouldn't say, hey, it's the fat cats of Wall Street sitting around a table that did all this, and we're not quite sure if they did it for themselves or they did it for us. At least we have an outside set of independent directors who look to be, you know, without their own agenda and will make decisions along these lines that are in the best interest of the exchange and the investing public. I have been told that I should shut up and leave, and I was delighted to be here, and thank you very much.